Hi, we're Group 3. Our group topic is monetary and portfolio balance approaches to external balance and exchange rates. And our group members are 伯乐星、优航史、朱思萌、余杭 and 梅崇熙爱. The first one is balance of payment and money market equilibrium. Balance of payments problems happen when there is a mismatch between money supply and demand. Too much money causes a balance of payment deficit. Too much demand causes a surplus. The second is monetary approach and equilibrium. Balance of payment is affected by the money market when money supply greater than money demand. So there's a deficit. And when money supply less than money demand, there is a surplus. The last one is market equilibrium. The money market is in balance when money supply equal to money demand. As shown, this graph says that if the central bank increases reserves and the money supply shifts from NS to NS1, there is too much money, leading to a balance of payment deficit under fixed exchange rates. Thank you. And empirical evidence shows that when domestic credit increase, net foreign assets decrease. It's bad for balance of payments. But when borrowed money and net foreign assets increase, it's good for balance of payment, proving the theory works in real life. So, the balance of payments, the deficit occur when money supply exceeds money demand, often due to central bank reserve expansion under fixed exchange rates.
Hello everyone, my name is 伯乐星. Today I'd like to briefly introduce the monetary approach to exchange rate and explain how monetary policy influences exchange rate movements. The monetary approach views the exchange rate as a relative price, specifically the price of one currency in terms of others. This price is driven by money supply and price level, and the theory is grounded in purchasing power parity, which states exchange rate equals domestic price level divided foreign price level. So what happens when a country increases in money supply? In the long run, this causes domestic price to rise. As prices go up, the domestic currency loses value relative to foreign currencies. In other words, the exchange rate increases and currency depreciates. The logic is money supply rise, then price rise, then exchange rate rise, then currency depreciates. Let's apply this to policy. Under a flexible exchange rate, the central bank must defend the exchange rate by using foreign reserves. But if the money supply keeps rising, the reserves may run out and the country may be forced to devalue its currency. In contrast, under floating exchange rate, the exchange rate adjusts naturally. An increase in the money supply leads a depreciation, which helps restore external balance without using reserves. Empirical studies suppose this will. Economists like Aliber and who found that in many developing countries, especially those with high inflation, money growth is closely tied to a long-run depreciation. In short, exchange rate reflect the monetary fundamental. Policy in practice depend on the exchange rate system. Simple exchange rate require monetary disciplines.
Okay, the third part is asset portfolio balance model, the interactive mechanism of interest rate differentials, capital flows, and international balance of payments. This model gives us a more realistic view of how capital moves internationally compared to traditional monetarist models. Instead of assuming investors only hold currency, the portfolio balance model shows that investors allocate their wealth across money, domestic bonds, and foreign bonds. Investor behavior is mainly influenced by three factors: interest rate differentials, exchange rate expectations, and risk premiums. These drive capital flows, which in turn affect exchange rates and the balance of payments. And the key in question in this model is modified uncovered interest rate parity. So it's ID equal RF plus XA minus RP. So in here, ID is the domestic interest rate, RF is foreign interest rate, XA is expect change in the exchange rate, and RP is the risk premium. This tells us if domestic interest rate is lower and the domestic currency is expected to depreciate, or foreign asset is seen as safer. Investors shift capital abroad that lead to capital outflow and currency depreciation. When central bank issue more domestic bonds, it shifts investor preference, causing capital flows that impact exchange rates and the balance of payments. This shows how interest rate influences factors and helps guide policy.
This model explains why exchange rates often move too much in short run. The main idea is that the prices of goods are sticky and change slowly, but financial markets like currency markets react quickly. So when there is a monetary shock, like a sudden increase in money supply, the exchange rate reacts sharply. And how it works. When the central bank increases the money supply, interest rates go down. Lower interest rates make investors move their money to other countries with higher return. This causes capital outflow and leads to a fast large depreciation of the local currency, more than what is needed in the long term. This is what we call overshooting. The exchange rate drops too much at first, but over time, as prices in the goods market adjust, the exchange rate slowly returns to a new long level. In short, the Dunn-Bosch model shows that in the short term, exchange rate can be very unstable because financial markets move fast, but prices are slowly to change. This helps us understand the high volatility in currency markets after economic shocks. In the diagram, we see a cover, which shows the relationship between exchange rates and output in the short run. When there is a monetary expansion, the AA cover shifts upwards to AA prime. This means at each level of output, the exchange rate must now be higher to keep assets market in balance. At first, the exchange rate jumps sharply from point E to point E prime. This is the overshooting effect. As this passes and prices in the goods market slowly adjust, the economic moves along the new AA prime cover back towards a new equilibrium.
This section compares monetarist and portfolio balance models in comparing exchange rate dynamics, emphasizing their conditions of applicability and place implications. Monetarist models based on PPP and UIP perform well in economies with stable money demand and open capital account. They explain 70% of exchange rate variation in OECD countries by linking money supply and price level to long-term exchange rate trends through the quantity theory of money. In contrast, portfolio models are more relevant in emerging markets with capital controls or heightened risk aversion, accounting for around 65% of short-term exchange rate volatility. They focus on capital flows, internal debt, and portfolio shifts, often resulting in exchange rates overshooting via the Tobin's Q effects. Policy recommendations include anchoring money supply to nominal GDP growth, employing macro-prudential tools, coordinating interest rates, and incorporating both models into the SGE framework. A combined approach leverages the strengths of each model to enhance exchange rate policy across different economic contexts.